Today's challenging economic environment, businesses and investors are searching for innovative ways to gain an advantage over their competitors. Analytic models are becoming the new buzzword in the investment space. And joining us now to explain more about the concept is Stephen Malinak. He is a global head of quantitative research and investor analytics at Thomson Reuters. Thanks so much, Stephen, for joining us this afternoon. Well, as I say, you've come through with the phrase analytic models can help an investment professional have the edge over competition. One assumes that it's proving to be pretty popular because it's what everyone's after. What exactly are we looking at?
So we're building models that score stocks all around the world. We actually score every traded stock every night, so you always have up-to-date information. We'll look at things like valuation, what a company should be worth, momentum, is it getting better or worse, quality, are their earnings sustainable, and people use this to get alerts on their portfolio, what they might want to buy or sell, and really stay on top of changing information.
Stephen, are you taking information that is in the public domain already, whether it be through Thomson Reuters or whatever, and just organising it in a more digestible way, or are you actually analysing it in a different way that can be interpreted, that is being interpreted in a way that other models don't, for example?
A bit of a combination of both. So we start with publicly available information. There are the filings from the financial statements. We have the estimates from the estimates database for all the sell-side analysts who are following the stock. And the unique edge that we add is we've analyzed all the sell-side analysts over the years. We know who's accurate at forecasting earnings for each stock. We found out that that's a very persistent skill. And if you follow the better analysts and the more recent forecasts, you can actually predict surprises in earnings. And that's very helpful for looking at valuation models and momentum signals.
So we're talking a lot of theory here. Let's look at, practically speaking, how this works. Give us a case study that illustrates what exactly you're looking at here.
Sure. So I pulled up a screen on some stocks in South Africa, and one of the ones that came toward the top was Mpact, the packaging company, and it got about the highest score it could on our combination model. And the reason for that is that the analysts have been revising their estimates up, and we've got a strong predicted surprise. And if you look at it, there aren't that many analysts who are following the stock, but the better analysts have revised their estimates in the past month or two. One of the analysts, it's been about 240 days since he's changed his number. And so the company has gotten a lot better over the past few months, and we're able to predict that when the earnings come out, it's going to be a surprise. And same thing with the valuation numbers. As those earnings go up, the company's worth more relative to those earnings. And we've seen the valuation we have on the company has about doubled in the past 2 years, and the price has gone up in response. So that's what we like to see, a company that's still undervalued and the earnings are going up. And we've got a strong earnings quality score on this too, which says it's got high profit margins and good cash flow backing all of this up.
Do you find that you have to formulate different models for different stocks, because one stock will have a certain personality, for example Mpact, and a gold stock will have a completely different one, so you have to sort of tweak your modelling accordingly?
Well, we found that the models are designed to do what the models do well. So analyst revisions will predict analyst movements, but if there are no analysts on a stock, you can't use that at all. So what we'll find is you might use different models on different stocks. So some, particularly in developing markets, price momentum works extremely well. So you might just buy the companies that have got the strongest price momentum. But when the market reverses, price momentum is going to take a little while to react, and so in those cases you want to fall back to something more like valuation. So what we see is we use the same technology to create the model scores around the world, but we'll use different combinations based on local circumstances.
How do we, how do things look on a continental basis when you're looking at Africa? Because, you're looking at a differentiation needing to be made between developed and emerging markets. If you're looking at frontier markets on the continent, the perception is, we always talk about Africa as this homogeneous entity, but it's not. We've got different countries with various factors at play.
Variety is fabulous for quantitative models. The more differentiation there is, the more ability you're able to do stock picking. And so we found, particularly in markets like Asia, where you have developed Asia and emerging and frontier, we've done some extensive studies there. The models work well in developed markets, better in emerging markets, and even better in frontier markets. So if you're actually able to get in and out of these positions with reasonable transactions cost, you can do extremely well. And so I would expect the same thing would be going on in the African markets as well.
I would imagine that the sector of the industry, the financial industry that uses this the most must be the hedge fund industry, Stephen.
Right, it's very popular with hedge funds, also pension funds, sovereign wealth funds, mutual funds, anybody who's an investment manager.
Yep, taking a look at Just how popular it's become. I mean, in terms of the kind of traction it's gained, what kind of track record are you boasting right now?
Well, it depends on where you are. If you look in emerging markets in general, over the past year, some of our models are up 30% when the weighted average of those stocks are only up about 8 or 10%. South Africa in particular, some of these were returning about 50% over the past year when the market was only up about 20. Some will do better than others, but we found the less widely followed a market is, the more, quote, alpha you can extract from stocks, the more you can beat a benchmark.